Thanks for coming back for episode 2. Hope you enjoyed the first one. So, I had a whole different story lined up, another story about Japanese culture, but I scrapped it because something happened last month that I think we need to talk about right now. The yen. It has reached a multi-decade inflection point. This channel covers culture, history, customs, language, and yeah, sometimes economics too. But here's why this matters. What's happening with the yen right now is going to affect anyone living in Japan, anyone thinking about moving there, or anyone investing there. So stick with me. Quick disclaimer, this is not financial advice. I'm just a guy who traded commodity futures in Tokyo during the late 1980s bubble and understands technical analysis. But don't worry, no jargon today. Just the story of how we got here and what might be coming. Let me show you what I'm talking about. They say every picture tells a story, so try to look at this like a photograph, not a financial chart for trading. This is a 50-year chart of the yen against the dollar. If you download a yen-dollar chart from any Forex website, it will look something like this. Look at it carefully. There is something counterintuitive about it. When the price movement goes down, the yen gets stronger. When the yen moves from 264 to 160 to 100, it is appreciating in value, although the chart shows it is falling. But what is actually falling is the dollar. So, to avoid confusion and make sense of what I'm about to tell you, I inverted the chart, turning it upside down. Now that's better. Same underlying data, but now when price moves up on the chart, the yen is strengthening, and vice versa. Look at the right side of the chart, and you see the yen at 161.2 on June 19th last month. Since then, it has consolidated below the 160 yen breakdown line. Charting aside, it looks like it is about to go over a cliff. 160 is the inflection point I was referring to. It doesn't signal an imminent crash, but it is worth noting. The yen hasn't traded below 160 for any sustained period since 1986. That's 4 decades ago. By the way, these charts are yours to download. The link is in the description. For me, 160 is a back to the future deja vu event. I was trading futures when we were at these levels last time. Before we get to the core historical event that set up what might come next, a few markers worth noting. In the bottom left-hand corner, you see that the yen was at 264 to the dollar when I arrived in Tokyo in July 1977. For the next 8 years, it fluctuated between 260 to 180 yen. Through the late 1980s and 1990s, the yen continued to strengthen, reaching its peak of 76.25 yen in March of 2011, after an earlier high of 79.75 in April of 1995. This set up the lost decades of 2000 to 2020, with the yen taking the top spot as the strongest currency of the major economies. So what kicked off this 40-year climb and lost decades? It all traces back to one meeting in September 1985. Finance ministers from the G5, the US, Japan, the UK, France, and West Germany met at the Plaza Hotel in New York. Here's the backstory. Japan had been keeping its markets closed to foreign manufactured goods for decades. Huge trade surpluses with the rest of the world was the result. The weak yen made American products unaffordable to Japanese consumers. So the G5 decided to solve this trade imbalance through currency manipulation. They called it the Plaza Agreement. This resulted in the red shaded area you see on the chart. The central banks intervened and coordinated the move. Bring the dollar down, push the yen up. At the time, the yen sat around 262 to the dollar. What happened next is the part I lived through. Within 2 years, by late 1987, the yen had strengthened to 140 to the dollar. And here's something that is missed. This massive currency manipulation is what led to the parabolic move in the Tokyo stock market and the inevitable crash into 1990. See, with a central bank guarantee for a stronger yen, overseas investment houses bought it up and locked in a risk-free currency play. Most of that money ended up in the Japanese stock market. That's the bubble I watched inflate. And by the time I left Tokyo in June 1997, yen at 116, the bubble had already burst years earlier. The 90s became a decade of brutal depression. So, will we see a rerun of 1986 to 87, but this time on the way down for the yen as shown in the yellow shaded area? Will market forces counter central bank intervention, supporting the yen at this critical juncture at 160 to the dollar? If 160 is breached, there's not much to support the currency down to the 180 level. No one knows the timing, but I think a considerably lower yen is inevitable in the long run. That's the full arc. 1977 to 1985, a weak yen. 1986 to 2020, 34 years of a strengthening or strong yen. And today, a weakening yen that just broke a 40-year floor. Okay, so who actually benefits from a weak yen? And who gets hurt? Japanese exporters, they win. Companies like Toyota, Sony, Nintendo, Hitachi, their overseas earnings converted back to yen are worth more. The strong yen hurt exporters in the 90s and the lost decades. A weak yen helps them now. Tourists, you win, big time. If you're visiting Japan with dollars, your money goes further than it has in 40 years. That's a huge part of why tourism is breaking records right now, closing in on 40 million annually, compared to 24 million just 10 years ago. People planning to buy real estate and set up a new life in Japan, including Akiya buyers. You're in a mixed bag middle ground. If you can continue to earn in dollars after your move to Japan, you'll have your cake and eat it too. If not, and your income will be in yen, that's another story. For Akiya buyers, a 5 million yen Akiya may become cheaper in dollar terms, but renovation costs could blow out with internal inflation inside Japan. And then there's the catch. The moment you move there and start living on yen, your exchange rate purchasing power evaporates. You're now earning, spending, and budgeting in a weak currency. So you can end up asset rich but cash flow poor, sitting on a cheap property in a country where your day-to-day money doesn't stretch like it used to. If you're weighing a move like this, the real question isn't what the Akiya costs today. It's whether you'll have yoyu once you're living there. That's a word I used in episode 1. It means margin. Room in your budget. Money to spare. Buying cheap in dollars doesn't guarantee a higher living standard once you're earning and spending in yen. I'll come back to this at the end, because yoyu has more meanings than when referring to money. Foreign residents earning yen, you lose ground, especially if you're sending money home, paying off foreign currency debt, or planning to eventually leave. Your yen buys less outside Japan than it did a few years ago. Exact opposite of the advantage I had in the 90s. Japanese households and importers, they lose. Japan imports almost all its energy and a huge chunk of its food. A weak yen makes both more expensive. That's a real cost of living squeeze for ordinary people through inflation and reduced purchasing power. And then there's the government, and this is the part I want you to understand. Japan is the largest foreign holder of U.S. Treasury debt in the world. The U.S. Treasury functions like Japan's savings account. When the yen weakens against the dollar, the yen value of that dollar-denominated account rises. The dollar doesn't need to rise, the yen just needs to fall, and Japan's existing dollar assets are worth more in yen terms. So while a weak yen squeezes the average household and reduces its purchasing power, it quietly inflates the yen value of the government's and Japan's largest institutional investors' dollar reserves. That's the tension underneath this story. A currency move like this is actually a redistribution of assets, creating winners and losers depending on where you sit. Exporter or importer, saver or spender, dollar holder or yen holder. Look at how a falling yen will improve the balance sheet of the Japanese government's reserves. At today's exchange rate, around 160 yen, Japan's reserves stand at 193.6 trillion in yen terms. At 180 yen, they would increase to 217.8 yen, and at 200 yen, its reserves balloon to 242 trillion yen equivalent. So, if the yen were to fall back to the 260 level before the Plaza Agreement was reached in 1985, its dollar reserves in yen would reach a staggering 314 trillion yen. So where does that leave us who live or want to live in Japan? At an inflection point. Real winners, real losers, and no way to know which way it breaks next. Which brings me back to where this channel started, back to that word, yo-yu. In episode 1, I talked about yo-yu in terms of time, space, money, and mindset. It's a Japanese word that wraps together meanings of abundance, capacity, leeway, margin, and affordability, depending on the context. It is a word that will be used a lot in coming episodes on this channel. The next move in the yen is going to bring more or take away your yo-yu in more ways than one, depending on your situation. I want to thank you for watching. Please comment. I want to learn about your experiences with Japan. And if you found this narrative useful, a like or subscribing will always be appreciated. Remember, you can download the charts from the link in the description. If you haven't seen episode 1, go watch it now. It's somewhere on your screen.